market movers. This is The Pulse with Francine Lacqua.
Morning, it's the third. Welcome to The Pulse. I'm Guy Johnson. A couple of pre-market things I just want to flag. Tesla's actually, I think, trading higher. US Steel, though, is under pressure. The Washington Post WAPO was pointing a little earlier on. We backed this up. Looks like Biden is going to pull the plug on the Nippon Steel acquisition. So that's not going to happen. US Steel is down by 7.5% off the back of that, unsurprisingly. Tesla, though, Tesla's up by 1.3% right now, despite the fact that it has missed. Looks like it's bouncing back. There was also some action in Apple. We'll come back to that one a little bit later on. Equity markets, though, more broadly, quite soft. US futures are pointing a little higher right now. I wonder how long that is going to last. But big reversal yesterday in US equities. So we started off quite strong, big reversal lower off the back of that. That's not a particularly positive signal when it comes to investor sentiment right now. So let's talk markets. Let's figure out what is going to happen here. Laura Cooper joining me around the table, global investment strategist at Nuveen. Good morning.
Good morning.
Happy New Year.
Happy New Year.
Is it going to be?
Is it going to be a good new year? Well, I think certainly you're looking at yesterday's price action, we probably can't say that. But I think given the thin liquidity that we are seeing in markets, we can't really take a signal from that. I think really it does capture what's going to be the dominant theme for this year. And that is one of uncertainty, whether that comes largely from Trump 2.0 and what that could look like, but as well looking at the growth and inflation outlooks and as well what the monetary policy response could be to the evolution of some incoming data.
Do you think market participants are though nervous looking at this year? You're coming in with kind of high elevated equity prices, trying to figure out what we're going to be doing. There's a lot of uncertainty kind of in the market. Do you think that's kind of permeating into people's expectations for what this year is going to look like?
I don't think that's yet kind of feeding into expectations. If we look particularly at earnings expectations in the U.S., I think a consensus theme is that we're going to see this U.S. exceptionalism persist. And looking at earnings expectations, they're roughly about 15% for the U.S. for the full year. That's about double what we typically see from a historical median perspective. And that's largely going to be driven by tech. But we're not seeing signs that, investors are very cautious, certainly heading into the...
How's Laura Cooper feeling about this? What are your expectations for this year? The S&P delivered 20%, 30% if you're a euro investor. Is this year going to look as good?
I mean, I guess, whether we can get the same type of magnitude of gains in this backdrop of uncertainty is highly unlikely, I would say. But I think this is going to be a year driven by rates volatility, by FX volatility, and that's going to be driven by divergence of what we're seeing in terms of monetary policy outlooks and as well growth outlooks. We're already seeing this U.S.-European growth growth divergence. Yep. We're seeing that play out in monetary policy. I think crucially we'll be watching for how central banks respond to that. We're seeing the Bank of England pricing just over 2 cuts, which does not seem to be very prudent in this environment where growth pressures are going to be more acute. So
what do you think is mispriced? So the gilt market, by the sounds of things. Yes. What else is mispriced?
I think the gilt market is one that comes to mind. If you think that we think the 10-year UK yield should be sub 4% by the end of the year, that's based on our assumptions that the Bank of England is likely going to have to cut rates, let's say on a quarterly basis, so 4 times this year. Elsewhere, in terms of market pricing, small caps in the U.S., we've seen those come under pressure to start the year. That's kind of opposite to what we would expect under the kind of the Trump 2.0 policy. In this environment where U.S. growth is going to continue to dominate, we're having tax cuts likely coming through. Yep. We're going to have tariffs. That's going to reorient activity domestically in the U.S. That should be a beneficiary for small caps, even if they are trading at a slightly higher valuation to the benchmark. We think there's opportunity still in this equity market.
Quite sensitive to higher rates, though. Is that going to be a problem?
That is the case, but I think markets, yes, they're pricing for this higher for longer backdrop. Probably going to see, let's say, 2 cuts from the Fed, but there's a great degree of uncertainty around that. I think in the near term, let's say the next 6 months or so, as we get clarity on the policy, we're going to see greater M&A action that's going to support small caps. I think it's really in the second half of the year where we're going to see more of that uncertainty come through, and that's largely driven by the outlook for price pressures. Are we going to see more of that inflationary impulse come through, not just from the first round of tariffs, but it's really around what the retaliatory actions could be in this global protectionist environment. And that's where we could see some of those estimates for inflation start to tick higher by the end of the year. And that, in turn, will lead to that higher for longer rates backdrop, weighing on more of the small cap
What does retaliation, do you think, look like? Essentially, the Chinese have let the currency go this morning through 7.3. That seems like a pretty good way of dealing with the tariff story.
And that is really one of the key pressure valves, I think, for the Chinese policymakers to kind of curtail some of the impact of these potential tariffs. If we think about a potential 60% import cost in terms of the Chinese tariffs, then yes, they're probably going to further depreciate their currency. I mean, our year-end target anywhere from 760, I think, at this point. So we've really materially raised it. I think there's a great deal of uncertainty that perhaps markets are not yet pricing.
A lot of you painted a picture of a lot of turbulence. Does Europe have the governments it needs to navigate this turbulence? Is Europe going to get left behind because it's turning inwards to try and figure out how it governs itself? France, Germany, etc.
I think we really struggled to see a catalyst for upside in terms of European growth. We had largely predicated kind of a potential upswing this year on a resumption of consumer spending on the back of real rising personal disposable incomes. We're not yet seeing that come through because it's an environment of depressed sentiment. And the tariff uncertainty is really just adding this overlay that we think is going to have sub 1% growth in Europe this year. So the question is, okay, the ECB, they're going to cut rates further.
Yep.
That's largely priced in, looking at implied policy path with a terminal of about 1.75%. So then it kind of, well, can we see that fiscal lever being pulled? And in this backdrop, that's not our base case.
Yeah.
If anything, we think the continent is set up for fiscal consolidation this year rather than a fiscal impulse, even though we hear some talk about, potential German fiscal flexibility.
Do you think the year starts today? Does it start now? Does it start on Monday morning on the 6th when everybody comes back to the office? Or does it start on the 20th when Donald Trump gets inaugurated? Do we have to wait until then in order to get some clarity on kind of how the rest of the year is really going to look?
Well, markets are forward-looking, and they're certainly trying to kind of guess what that policy outcome could be, I think, at this point. But I think we are going to see some of that front-running further. I mean, certainly the Trump 2.0 policies are not necessarily playing out as one would expect. Some, like the dollar strength, we are seeing. But I think we really need to see more of that clarity on January 20th for markets to have greater conviction. But I think U.S. exceptionalism will continue to be the dominant theme, at least in the first half of the year, regardless of what some of those policies come through are.
Laura, always great to see you. Thank you very much indeed for coming to see us. Laura Cooper, Global Investment Strategist, joining us at Nuveen, from Nuveen. What are we going to talk about next? Tensions remain high in South Korea. The country's impeached president, Yoon Suk-yeol, resisting arrest. Are they going to have another go? We will find out next. This is Bloomberg. I want to give you an update as to what is happening in South Korea. Authorities there have failed in their initial attempts to arrest the impeached president, Yoon Suk-yeol. This afternoon, a 6-hour standoff with his security team and protesters who had gathered outside his main residence. Katria Dmitrieva has been tracking all the developments. So we want to know what happens next. This feels like an amazing standoff that we're watching taking place in Seoul. What are the next steps that the authorities are going to take in their attempts to arrest Yoon?
Yeah, and it was a very tense standoff for about 6 hours this morning, starting from just as dawn was breaking over Seoul, with nearly 3,000 police officers as well as the CIO coming to Yoon's residence to try and execute this arrest warrant. Of course, they were greeted by about 200 of his own security detail that included people of a military unit who are basically sworn to defend Yoon, as well as essentially a wall of protesters that these are people who are big supporters of Yoon's and civilians at the end of the day. And so they weren't able to execute that warrant. They were not able to even come within 200 meters of Yoon, as we heard earlier today. Now, the next step is really an open question. They still have this warrant that's available to them until January 6th, until Monday end of day. So they still could technically do this again, let's say tomorrow or whenever they decide. The CIO had a press conference earlier today, and officials said that they're still considering next steps. They're kind of going back to the drawing board, because the reality is that they just couldn't do it today because of the resistance that they face, not just from the security, but also from civilians. And so there was a risk to safety for personnel. And so if they do it again, it's pretty clear that it might be the same repetition. So the question is, do they try to do this again before January 6th? And then we look forward to the impeachment trial, which is January 14th.
So when I read this story overnight, the first thing I did was went and checked what South Korean markets were doing. And I was anticipating that we would see a negative response to this standoff and extra political instability. I saw the exact opposite. Equity markets were higher. Can you draw a line between one event and the other?
Yeah, I think you and everyone else thought that this was going to take the Kospi down or kind of see the won move down again, because we've had on the Kospi now 5 straight days of losses because of this political turmoil. But today it was actually up. So we saw the stocks moving higher today and the won sort of finding its balance. And I think really the reason behind that is because a lot of this political turmoil is already priced in. And so traders went in, investors went in and saw a buying opportunity today on this news. And at the end of the day, South Korea is still a democracy. There's still this trial that's happening January 14th, this impeachment trial that begins. And there is a sense that there will be some resolution. It just will probably take a little while.
Katia, thanks for the update. Really appreciate it. We'll continue to monitor this story, or I know you'll certainly continue to monitor this story for us as well. Katia Dmitrieva, thank you very much indeed. Let's turn to what is happening in the United States. Their investigators, I can't say that word this morning, say they found no evidence linking deadly attacks in New Orleans and Las Vegas. The FBI continues to examine the 2 incidents that rattled Americans as they rang in the new year. Let's bring in Derek Warbank for more on this. Derek, there appear to be similarities, but there are obviously enough differences that the authorities think that there is no connection between these 2. Can you kind of walk us through what we've learned?
Yeah, that's right. And the authorities are being very clear to say that they do not have a definitive link between the attack in New Orleans and the explosion in Las Vegas. But as you say, there are some similarities between the cases. Both are individuals who had served in the U.S. Army. In fact, they were in Afghanistan in 2009, both of them. They both rented vehicles from the same startup app. There are certain things about these cases that have made some people think that there may be some, as you say, similarities. But authorities have been clear they have not found any link between the 2 of them as yet. Obviously, investigations are still ongoing. One thing that we are expecting to see, and you're already seeing early signs of, is an increased security posture for major events in the United States, like the Sugar Bowl college football game that was due to take place. Yep. Took place a day later, and the biggest event of all of those is Donald Trump's own inauguration coming up later this month in Washington, D.C.
So how is it changing? Is it changing? Is this changing the security profile around that event? To what extent is it being changed? I would imagine security is already pretty high.
Yeah, look, I've covered a lot of presidential inaugurations, and they are just the most fortified occasions you can ever think of for a major American city. However, every single one of those is going to be gone through with a fine-tooth comb yet again. And let's not forget, the security apparatus around presidents is already under some amount of scrutiny and focus, given the assassination attempt on President-elect Donald Trump's life back into the campaign in Pennsylvania, right? So there was already going to be a focus. There was already going to be a review. But you can expect there will be even more security, even more review on that in the days ahead.
Derek, great stuff. Thanks for the update. Really appreciate it. Bloomberg's Derek Warbank. Coming up, we're going to take you from Trump to Tesla, which feels like an obvious connection these days. The stock recovering some ground pre-market, reported its first annual sales drop in over a decade, Tesla. We'll take a closer look at what it means for the car maker next. This is Bloomberg. Let's turn to Tesla. Shares a little higher this morning, pre-markets, but not enough to make up for yesterday's drop. 6% was the drop yesterday, so we're bouncing back a little bit. The company reported its first annual vehicle sales drop in over a decade. It's interesting, you've got Morgan Stanley out talking about a sort of aging lineup from Tesla. Let's get a take now from Taipei. Danny Lee joins us from there. So Tesla down pretty sharply yesterday. We saw a sales miss coming through. How big a disappointment was this in reality? The stock's coming back a little bit this morning.
This is really only a marginal disappointment considering the kind of high-level numbers it was still able to achieve, just shy of 500,000 EV deliveries, and still numbers that nobody thought it could ever reach. These are levels that it has never been able to reach before. So really robust set of numbers, although a miss for the street who wanted 512,000. And again, Tesla was still confident that it could deliver on that slight growth. So, that's why investors were disappointed. But the morning after, we are seeing obviously those shares turn a little bit higher potentially on the pre-market.
Let's connect a few dots here. You've also got some interesting stories happening elsewhere in the EV space. Let's talk about this China story. China looking maybe to curb exports of key materials, key technology that go into EV batteries. Is this just sort of reciprocity given the hostility they're seeing from the United States, or is this about China trying to preserve its lead in battery technology?
It's a combination of both these things. Beijing has been put under a lot of pressure when it comes to things such as tariffs and other tit-for-tat measures. And, it still has its own cards it can push and play here. And particularly as still the world wants to transition to EVs, China does control a critical amount of that EV supply chain here. So it has cards it can play here, and particularly as it looks to propose tougher scrutiny, tighter export controls on these kind of technologies here. So, this is its answer. And, it still kind of answers some of the worries that both Washington and Brussels have in relation to the kind of controls that China does have and dominates in, and why there has been an effort globally to try and loosen China's grip here. So, China's trying to push back a little bit, but, as we see, there's always going to be a level of tit-for-tat, particularly in this EV space.
We've also got the Cybertruck, Tesla's Cybertruck, now getting the US tax credit. Some European car makers are under pressure, though. Looks like there's a few winners and losers here. Yeah,
the actual new list, the revised list of since January 1st of EVs and hybrids that are eligible. So Cybertruck is the main winner here in terms of being one of the new entrants on that list. But that entire list is narrowed from 22 to 18, in fact. And so we do see the likes of Hyundai and Kia who do benefit, but then you see the likes of Ford, Volkswagen, Nissan, and Stellantis all lose out with its car models being stripped of that $7,500 US dollar federal tax credit or thereabouts. And so at least, there are going to be some consumers who will pivot more towards those kind of EVs or hybrids which do get that tax credit, and that's going to have an impact on sales, and that's going to flow through. But given how we have seen EV sales slow down more broadly, what does this actually mean for EV car maker strategies, who've really relied on those EV sales, but actually consumers do want more hybrids. So, key thing here is what that means for strategy going forward here.
Danny, great stuff. Thank you very much indeed. Bloomberg Asia transport reporter Danny Lee joining us from Taipei. When we come back, we'll carry on actually a conversation that relates to what is happening with China and Asia and the whole steel industry and how Japan is playing into that. Months of political controversy coming to an end. Bloomberg understanding that President Biden will block the $14 billion sale of US steel to Japanese rival Nippon Steel. What does that mean as we head into the Trump administration? We'll talk about that next. This is Bloomberg. Welcome back. Half past the hour. It's the third 3 days into the year, 2 days from a market point of view, I guess you could argue. European stocks under a little bit of pressure. It's an interesting mix today in terms of what is going on. As you can see, 600 is down by 0.2%. You've actually got some fairly big disbursement in Europe this morning. The FTSE's doing better. The French market under significant pressure. Euro dollar a little higher this morning, but still trading with a 102 handle, 102.95. You've also seen the Chinese let their currency slip through 7.3 to the upside. So you're seeing weakness coming through in the Chinese currency. Is this an early indication maybe of how the Chinese are going to respond to the possibility of tariffs coming through from the new Trump administration? We are awaiting data coming through also out of the UK. We're going to get some numbers there. Let's run you through some headlines before we get you to those. Tesla recovered some ground in pre-market trading, this after reporting a drop in annual EV sales. Hasn't done that for a decade. South Korean investigators failing to arrest impeached President Yoon Suk-yeol. They're going to have another go apparently later. We'll wait and see what happens there. Let's talk about the cross-asset numbers, show you what is going on there again. I think it's a really interesting day today in a way that I didn't expect it to be. We're also getting data coming through from the UK right now. You've got mortgage approvals at 65.7. That's lower than anticipated. This is the number coming through. I'm just seeing dropping on the screen right now. I'm just going to try and see if there's some details coming through here. But this is actually quite a lot weaker. We saw some house price data early on in the week suggesting that actually we are seeing prices rising, so you would have thought that maybe that would pull through maybe into the approvals. That isn't the case. Mortgage rates are remaining reasonably elevated. If you take a look at the swaps rate, approvals have been ticking higher throughout 23, 24. Does that trend continue? Anyway, we'll come back to all of this in just a few minutes' time. Let's talk as well as to what is happening elsewhere around the world. One of the other stories that we're very much focused on is what is happening with US Steel. Its share price is under pressure, falling sharply, pre-market trading. Bloomberg understands that the White House is planning to announce later today that President Biden will block its sale to Japan's Nippon Steel. It was a deal worth $14 billion, and it's faced months, of course, of vocal opposition from the White House, competing arguments over the future of the US industrial giants, national security being thrown into the mix. Let's go to Jill Jesus, who joins us on this story. Jill, we had anticipated that President Biden would pull the plug. Is it any surprise today that we are seeing what we are seeing? The stock is under pressure. What's the next thing that happens here in this process? Is it done and dusted?
Yeah, I think at this point, Guy, I mean, it's not really that big of a surprise. I will point out that while you are seeing that drop pre-market, investors have really been betting against the steel for quite a while, because it's not just, sitting President Joe Biden that voices opposition to this. It's Donald Trump, the incoming president, as well. I mean, this was receiving really, really big backlash from Washington. So there was a lot of skepticism that this would go through. We saw the share price trading, around $30, $35 a share just last month. I mean, well below what the offer price was of $55. So, I mean, you're already seeing a lot of nervousness about whether or not this would go ahead. What actually happens next, though, I mean, that is the big question. And at this point, what analysts were saying when it already became clear that the Biden administration was likely to oppose this deal was that, it could be that U.S. Steel gets sold off for parts. I mean, before Nippon Steel came into the picture here with this $14 billion deal, you had some other interested buyers, including, company Cleveland-Cliffs, did express some interest. They've since gone on to, pursue a Canadian company instead. So it's not entirely clear that with this really unique combination of assets that U.S. Steel ultimately has, if there's really one buyer there, it seems that there's a possibility that maybe, that might be split up.
What do you think the next administration's view on the wider steel industry is going to be? We spend a lot of time talking about tariffs at the moment, and I'm wondering how we fold the steel story into that narrative.
Well, at this point, I think, one thing that will be really interesting to watch is, whether or not Trump actually pursues some of the case that was laid out against the Nippon U.S. Steel deal in some of what the Treasury Department was putting together. So, CFIUS ultimately left the recommendation open to Biden. That's the agency that was reviewing this deal. But part of the Biden administration's, sort of protest against the Nippon Steel deal for U.S. Steel was actually on national security grounds, which was really interesting to watch because normally when you see things that are brought to CFIUS, he's reviewing these types of deals, you see a lot of that, sort of directed toward, countries that have more antagonistic relationships with the U.S., like, deals like, a Chinese company kind of coming in to purchase some kind of a U.S. asset. You don't really see that with with an ally in the form that, you saw with Japan. So I think what will be interesting to watch, you see, Trump obviously has an incredibly protectionist attitude toward, a lot of, companies and products and things like that. It'll be really interesting to see if you see, that kind of attitude prevail. Although, again, Trump has kind of, framed his entire persona around a guy that really likes making deals if it's the right kind of deal. So I think it really is an open question as to what Trump actually wants. But again, you kind of have to kind of pick at those through lines to see whether those are trends that may, persist in a Republican administration again.
All will become clear, maybe, this year. Jill Desis, thank you very much indeed, joining us out of Hong Kong. Let's carry on the conversation. The prospect of higher trade tensions with Donald Trump in the White House, as well as political instability in Paris, Berlin. We've got a war still raging in Ukraine, all weighing heavily on the economic outlook for the euro area. What is going to determine its path this year? Well, let's kick that around a little bit. Jamie Rush, Chief Europe Economist for Bloomberg Economics, joining me around the table. Antonio Barroso, Senior Geoeconomics Analyst for Europe, joining us out of Geneva to discuss all of this. Jamie, if I think about how I frame 2025 for Europe, what are the key inputs? If you were to think about a model and kind of the key inputs that you need to put into that model to determine what the outcome is going to be, are they different this year than they would have been normally?
Well, let's think about the base case. What would have happened had nothing else been going on? Well, unemployment is really low. Inflation is falling, so it's reducing the squeeze on consumer spending power, and interest rates are coming down. That is an environment where you should see consumer spending go up, investment go up, and frankly, it's not happening, and it's not going to happen. Whilst we have this uncertainty around how Trump's going to tackle the trade war. And would you build a factory if you thought that the thing you make is going to have a 10% tariff on it, or a 40%, or a 20%? No, you're just going to park it, you can delay, defer, until the right moment comes, the clarity is revealed, and then you can make that investment decision. So I think this is the thing, this is the main channel we're going to see Trump affecting Europe through. Tariffs, separate question, the impacts there could be a little bit larger.
Antonio, is it just Trump that's causing the instability in terms of what we are seeing in Europe? If I'm a German company and I'm looking to build a factory, am I going to build it in Europe right now? Trump's going to be one of the factors that I think about, but energy costs and so many other inputs seem to be so relevant at the moment, and they all seem to be being impacted by the geopolitical situation. Are we going to get any sense of clarity this year on those key factors from your point of view? Jamie's talking about the uncertainty and Trump, but there seem to be so many that are hitting Europe at the moment. Political instability, France and Germany, energy costs, another key input to the European economy, a huge challenge there. We just don't seem to know an awful lot about what is happening and what is going to happen.
Sure, and look, the first factor of stability is not necessarily geopolitical, but just political, plain political, domestic political, right? Because when you look at France and Germany, these are two countries that don't have, an approved budget for 2025. But also in Spain, we forget, Spain has rolled over its budget 6 times since 2016. And it all comes down to the same trend, which is political fragmentation. I mean, we talk a lot about fragmentation as a feature of political systems now in the large economies of Europe. But the reality is that it has very specific policy impacts. And I think, you're going to see it in France, where you have a government that is going to struggle to, again, get a budget passed in parliament. You might well see a political crisis in the first quarter of this year. And also in Germany, where fragmentation and polarization is what has led the current government to collapse. And one key issue, for example, in Germany that has very specific economic policy consequences is, will Germany invest enough? Well, that depends on whether there will be a reform of the debt brake. However, given that polarization that you see in Germany, the party that seems to be leading the polls, the CDU, the center-right party, has said in its program, no, we will stick to the debt brake, because they don't want to essentially scare off right-wing voters, right? So I think, it's going to be difficult to get some clarity on those issues, but you will need clarity eventually.
Do we know what Europe's priorities are? So we've got uncertainty. Jamie's talked about that. Do we know what Europe's priorities are? It's got a defence spending story that it's got to deal with. It's got an energy transition story that it's got to deal with. It's got a tariff story that it's got to deal with. Do we have a sense at this point that Europe understands how to kind of sequence these priorities? I would have thought it's almost a zero-sum game. It can't do everything. Does it understand yet how to prioritise?
I think Europe understands. It depends what you mean by Europe. I think the challenges are relatively similar in different countries, but when you look from the point of view of the macro story and from the point of view of Brussels, I think the challenge is understood. From the point of view of the economy, a massive focus of the first half of the year is going to be to focus on competitiveness. That's the new buzzword that you have in Brussels right now, which comes from the report that former Italian Prime Minister Mario Draghi released last year. Yeah. I think you're going to see a lot of focus on that. For example, a clean energy, clean economy industrial pact that will be published in the first weeks of the year. But also, from the point of view of competitiveness, impact on simplification of reporting requirements, deregulation, and so on and so forth. That's on the macro domestic, so to speak. And then you have the geopolitical challenge. I think the main focus right now is obviously Trump, but there is another big geopolitical challenge, beyond the war in Ukraine, which is a key priority, is also China. What happens if Trump imposes tariffs on China, and then that leads to the exporting of overcapacity to Europe? I mean, that's a big concern, and I do think European leaders understand the challenges that are going to come during the year.
Okay. Jamie, does Europe have the capacity, though, to retool in the way that it needs to kind of reorientate itself? There is a geopolitical threat. We need to retool. We need to rearm. A lot of money needs to go down that route. We have an energy crisis. We need to manage that and spend to deal with that. We have a welfare system that is incredibly expensive. Is it a zero-sum game? Should I think about it as a zero-sum game in order for Europe to... Can it do all those things at the same time simultaneously?
Well, I mean, frankly, the answer is no, because they don't have the fiscal space at the national level to be able to do so, and there's no willingness at the EU level to do it, to bring public finances together. So they're not going to exploit that fiscal space. Defence, retooling, innovation, energy, hugely important, and actually much the most important thing to be tackling over the next 10 years for Europe. Trump, tariffs, that's what's going to be taking their time, their bandwidth. Yep. The big problem here is that Trump is distracting them, or will distract them over the next 6 months from the real problems that they face, the important ones like productivity, competitiveness, and actually defending the borders.
If we are going to be distracted and there's these huge priorities out there, can we get a stronger economy? The productivity story is really interesting. There are kind of all kinds of challenges that Europe needs to face. But as we were hearing from Antonio, the buzzword is competitiveness. Do you get how big an impact does regulation have on Europe's ability to generate greater productivity? How hamstrung is Europe by, to use a simplified term, red tape at the moment?
I mean, it's a social choice, right? So the red tape is there to protect consumers in the European market. That's a decision. You trade off some growth for the social model, right? That's a choice. That's fine. It means you won't get a European Google. But maybe we don't want a European Google. I mean, it's not obvious that that's exactly what's needed. What Europe has failed to do, which all countries have signed up to do in theory, is make use of the scale of Europe, the single markets, right? They've all said they want capital markets union. They've signed up to that. They're not delivering it. And until Europe is joined up in terms of its markets, it's joined up in terms of its policies with respect to innovation, with research. We're not going to see a big leap
more Europe,
forward.
not less Europe, is in some ways what's required.
Yeah, and as we heard from Antonio, that's exactly the opposite way the politics is moving. And so unless you get a change in the political deadlock in these countries and fragmentation starts to be eased, we're not going to see progress. And I think that's the problem, is that we aren't going to see progress over the next few years on the level that's required to sustain Europe's future. It's
December the 3rd. I feel good already about 2025. Jamie Rush, Chief European Economist at Bloomberg Economics. Antonio Barroso, Senior Geoeconomic Analyst for Europe, joining us out of Geneva. Thank you very much indeed. Coming up, we're going to have more on Germany ahead of those elections in February. We're going to ask just how fragmented is the country's politics. This is German politics we're talking about, not just European politics. German politics, incredibly fragmented right now. We'll talk about that next. This is Bloomberg. Let's get back to European politics. Let's get a little bit more granular. Campaigning well underway in the German election. Next week, the CSU will hold a caucus meeting near Munich. Plus, we're going to get a raft of key economic data out of Europe's biggest economy, factory orders, all-important reading on inflation, all of that coming next week. Ollie Crook joins us now from Berlin. Ollie, we're a couple of months away, and I'm really struggling to get clarity on what is happening in Germany, which way the vote is ultimately going to go, what kind of a government is going to be formed. What do we know at this point?
Yeah, listen, Guy, I think you're asking the right question here because, I mean, if you pull up the scores in the latest polling that we have here, it's telling the story that we've been seeing over the last couple of weeks. A couple of shifts here with the CDU gaining a little bit, the AfD gaining a little bit. But you look at these scores, where do you see 50%? If you basically count out the AfD, because nobody will enter into coalition with them, how do you get to 50%? And this is precisely at the heart of the question, Guy. This last government failed because there was total disagreement within the coalition. Are you getting another recipe, basically, for the same kind of uncertainty? That is the question, particularly now at a time, Guy, where you got even more sort of attention going on the AfD, namely from Elon Musk, who's been weighing into German politics for the last month, who's calling Olaf Scholz a sort of incompetent fool, who's saying that the president of Germany is a sort of anti-democratic tyrant. This is creating a lot of frustration and irritation within the political mainstream in Germany for all of the parties here. But Guy, another point that you were talking about a little bit earlier is the fragmentation within this country. And what's interesting is when you look at the map of where the sort of different strongholds are for the different parts of the German sort of political complex, you see a very sort of clear picture here. One of the first things you see, Guy, is not a lot of red on this screen. That would be the SPD. As you can see, the SPD has been kind of washed out. The support has been massively eroded. The gray has moved in. That is the CDU. These are state election pollings, by the way, so this is not an actual representation of how people vote. People maybe are a little bit more daring when it comes to state elections because they know there isn't as much power, but it does illustrate sort of where the strongholds are. What you notice immediately, though, is the AfD, the blue here, it is all basically held in the former communist east part of Germany here, and even in these two areas, Saxony and Lower Saxony, the CDU is only gaining by about 1 point. So we're talking about a fifth of the vote that is going to the AfD, a party that, by the way, wants to bring Germany out of the Eurozone, being really supported here by the eastern part of Germany, the former communist east.
What is this election about? I would have thought it would be about the economy. Is that really the reality?
I think that it is about a number of different things, but I think the economy is something that you just have to sort of pay attention to in a very dramatic way. I mean, Guy, we've been talking about it for the last 2 years, the difficulty of the German economy. I thought we might just put that into context in terms of what German growth has looked like for the last 75 years. These are the sort of average sort of decades, the growth rate at the average decade since 1950, 75 years of German growth. About 8% in the post-war years. Then in the 1960s, about 4.5%. In the 70s, down to 3%. And in the 80s, at about 3% again. And then you had this critical moment here, Guy, in 1989, the fall of the Berlin Wall, the reunification of Germany, and you have the sort of growth ticking along at about 2% in the 90s, and about 2000 and 2010, averaging at about 1%. To put this stuff into context, Guy, basically there have been 8 years or so of contraction since 1950 in Germany. 2 of those will be the last 2 years. And again, returning to the back conversation we just had about the political breakdown, there is a very clear line between the politics and the economics of Germany. Take a look of GDP per capita within Germany. This sort of huge discrepancy that exists with the former communist East below 40,000 euros, basically, to the rest of Germany. So this has been a very sort of high growth economy. This is an economy that has specialized in a great many things across the world, leading sort of exports across a number of different sort of sectors, but that has not been evenly distributed, and you're seeing that sort of economic, cultural discrepancy that is turning into a very sort of clear political fragmentation in this election just 2 months away.
Unification. I remember the taxes. Have they delivered? Ollie Crook may be pouring a little cold water on that idea. Ollie, joining us out of Berlin. Thank you very much indeed. Coming up, the European city where companies are most flexible when it comes to working from home. We're going to have the latest survey from Bloomberg Intelligence. That conversation is coming up next. This is Bloomberg. So the results from the work from home survey by Bloomberg Intelligence shows that 89% of London-based employers are amiable to remote working, more than peers in other European cities. Joining us now to discuss all of this, Sarah Munden, senior analyst for real estate and head of EMEA at Bloomberg Intelligence. Nice to see you. what does this mean for landlords? So I look around the City of London, I see new buildings going up, I see some great buildings here, but I also see a lot of other stuff here in the City of London as well. So what does this trend, this stickiness of work from home mean for these landlords?
It seems to mean, and the landlords are actually corroborating what we've got from our survey, that super prime property is doing all right, rents are moving up, and it's mainly full. I think the occupancy there is sort of 97% plus.
Yep.
But in the rest, it's really quite poor. So in the City of London, we've been running vacancy well into double digits ever since the pandemic. The West End has sort of doubled. It's up to near 7 or 8%. And the same has happened across other European cities as well. You look at Paris, La Défense, horror story.
Yep.
But
Canary Wharf.
Prime.
Yep.
Yeah. Canary Wharf is bad, but prime CBD in Paris, because of the height restrictions, still got quite high occupancy.
In terms of, therefore, what happens next, quite a lot of supply coming on in London, super prime doing relatively well, working from home feels like it's getting embedded. What does the next year look like? How does the picture evolve from here?
I mean, there is still quite good demand for super prime property, but the statistics show that there's quite a lot of speculative offices coming off in central London during 2025. So even though there is good demand, and that's where everyone's moving to, so their lease expires in a second-hand property, they're moving into prime because that's what our survey is showing everybody wants. They prefer to have well-located offices. But there may be some indigestion in that in terms of rent, so we might not see the growth in rents in super prime this year that we saw last year, where they were up to 6%.
OK.
Or more even.
Quite literally, watch this space.
Thank you.
Thank you very much indeed. Sue Munden of Bloomberg Intelligence. Up next, it is the Bloomberg Brief. Danny Berger, Manus Cranny in New York, setting up the day. We're looking at Tesla, we're going to be looking at Apple, we're going to be looking at US Steel. All of that, part of the conversation that they will be having next. I'll leave you with US futures. Have a great weekend, folks. This is Bloomberg.